We've already said that accounting is a process of measuring and recording business transactions. Let's take a look at some examples to see exactly how accounting goes through the process of measuring and recording business transactions. We will use a very simple example company, very creatively named ABC Company. ABC Company will undertake 6 transactions that we will measure and record and then put ultimately into financial statements. So let's take a look real quickly at what these 6 transactions are. The first transaction, to begin business, ABC Company will issue common stock in exchange for cash of $50,000. Secondly, it will obtain more cash by borrowing $40,000 from a bank. And it will issue a note payable to the bank as evidence of its intention to pay it back. So in other words, we're going to borrow money, we're going to get cash from the bank. In exchange, we give the bank a note saying, I will pay you back $40,000 plus whatever interest. The third thing it's going to do is purchase a building in which to operate for $30,000 cash. Fourthly, it will fill that building with inventory. That it purchases for $16,000. Fifthly, a customer will come in and buy half of the inventory, so we're going to sell one half of our inventory. Their selling price is going to be $25,000. And we're going to sell on account. What this means is that the customer does not pay us cash, but we will send the customer a bill at some point in the future, and the customer has some period of time, 15, 30 days, whatever it might be, to pay us back. So we have sold the inventory, we have given the customer the inventory, but we have not collected the cash yet. Businesses generally do this to make it easier for customers to buy more, and businesses assume that the risk that we won't get paid back in the future is relatively small, and the benefit we get by selling more is relatively big. The sixth thing the business will do is pay its employees $7,000 for the work that they have done. So these 6 relatively simple, very common transactions are things that this business will undertake, and we will analyze these transactions to come up with a way of measuring them, and then we will record them. As you will recall, our basic framework for recording and measuring and accounting for business transactions is our fundamental accounting equation: assets equal liabilities plus equity, A equals L plus E. Now, equity has multiple components that are different from each other in ways that are worth pointing out. So one thing we want to keep track of when we keep track of equity is whether the equity is contributed capital, in other words, money put in by the owners, or whether it is earned capital, money that the business earns by operating. Earned capital is increased when the business earns revenue by selling things to customers, and earned capital is decreased when the company incurs expenses, consumes some of its resources, cash or other assets, to get some services or goods. So we have assets, liabilities, and equity, And we're going to break our equity down into two components, contributed capital and earned capital, and then earned capital is further going to be broken down into revenues and expenses. This will help us measure and record the transactions. So let's take a look at the first transaction. We're going to issue common stock in exchange for cash for $50,000. I've always found it's easiest to look for cash in a transaction and start there. It's usually pretty easy to figure out what's happening with cash. In this case, the business's cash is increasing by $50,000. So cash is an asset. We're going to increase our assets by $50,000. What is the business giving up, or why is the business getting $50,000 cash? Well, the business is giving to its owners common stock. In other words, it's giving ownership essentially to the owners of the business worth $50,000. The owners have contributed capital in the amount of $50,000 to the business. So we can see an increase in cash of $50,000, that's an asset, an increase in contributed capital of $50,000, that's equity. Our assets equal our liabilities and equity. Assets have gone up 50, liabilities and equity have gone up 50. To record this analysis in accounting form, what we'll do is we'll create a journal entry. A journal entry will have a debit of $50,000 to cash and a credit of $50,000 to equity. So we record our debits all the way on the left. We're going to record a debit to cash of $50,000, indent and record our credit to common stock of $50,000. And this is our first transaction. We've analyzed it, seen where it fits in the accounting equation, and then written a journal entry. Our second transaction, borrowing $40,000 from a bank in exchange for a note payable. In this case, again, cash is coming into the business, so we've got an increase of assets. We also, in this case, have a liability. The bank is not an owner of the business. The bank is giving us cash not in exchange for ownership, but in exchange for a promise to repay them plus interest. We owe the bank $40,000. We have a liability, so we've got an increased liability of $40,000. When we borrow money from a bank, there's no effect anywhere on equity. So to record this analyzed transaction in journal entry form, again, we're going to increase cash with a debit. We're going to record our liability, a note payable. We increase liabilities with a credit, so we'll increase this note payable liability with a credit of $40,000. Our third transaction, purchasing a building for $30,000 cash. Again, start with cash. What's happening? Cash is leaving the business. We're writing a check to somebody else, the previous owner of the building, for $30,000. So we know cash is going down. What is happening? Are we paying off anything we previously owed somebody? Well, no, we haven't bought the building before, so we didn't owe anybody. And we're not having any transaction with owners, so there's no equity component. What we're doing is we are buying another asset. So in this case, we have no change on the right-hand side of our equation. We have a $30,000 increase and a $30,000 decrease simultaneously on the left-hand side of our equation. Assets go up and down $30,000, which means net they're unchanged. Liabilities and equity are unchanged. Our accounting equation is still in balance. So in this case, we're going to record a credit to cash, because cash is going down, and a debit to building, because the building asset account is going to go up. And that is our third transaction. Our fourth transaction, purchasing inventory for $16,000. This is similar to what we have just done. We are purchasing something for cash, so our cash is going to go down. We are getting an asset. So asset is increasing $16,000 for inventory. And our assets are also decreasing $16,000 for cash. Again, no change to liabilities or equity. So similarly to Journal Entry 3, Journal Entry 4 will record a debit to an asset account, inventory, for $16,000, and a credit of $16,000 for a cash account. So far, you will notice that there have been no entries whatsoever to earned capital. There have not been any sales. There have not been any expenses. All of the transactions we've dealt with so far are dealing directly with assets, liabilities, or contributed capital. Journal Entry 5 will change that. So we've got assets, liabilities, and equity in these columns. Contributed capital, earned capital, revenue, and expense. In Journal Entry 5, we sell half of our inventory for a selling price of $25,000. So half of the inventory that we used to have, we no longer have anymore when we've sold it. So we do have to recognize that our asset is going down. If our inventory had cost us $16,000 and we're getting rid of half of that, we have to get rid of half of that, or $8,000 of inventory. Now, what's the other side of this transaction? Well, because we no longer have the asset. We used to have the inventory. We don't have it anymore. Our asset has gone down. We've used up an asset in the operations of our business. That's going to give us an expense. So we're going to have an expense, which is going to make earned capital go down in the amount of $8,000. Because these are goods that we are selling, we're going to call this account cost of goods sold. We are increasing the expense account, but because increasing expense decreases earned capital, I'm going to put a downward arrow over here to show that our decrease in assets is offset by a decrease in earned capital for the $8,000. Now, this sounds like a bad thing, but it's actually not. Why is this not a bad thing? Well, decreasing our earned capital by $8,000, we're only doing that because we're also selling the goods for $25,000. So we're going to increase our earned capital with $25,000 of revenue. How do we offset the $25,000 of revenue? Well, we're selling this on account. What that means is somebody has promised to pay us. They haven't given us the cash, but we do have a claim against them. We have extended credit to them, and we have a claim on their assets of $25,000. We have, in effect, a promise for them to pay us. So we have a belief we're going to have future cash flows. We call this an account receivable. We have an account with the customer, an accounting of how much they owe us, and it is receivable by our business. We are always, in a sense, self-centered when we do our accounting. We record these things from our own standpoint, and this is an account we plan to receive, so we call it an accounts receivable. We have increased our assets by this $25,000 account receivable. We now have a claim against somebody else for $25,000, and we have sales revenue of $25,000. So Journal Entry 5 needs to record both the increase in accounts receivable and decrease in inventory. It also records the increase in revenue and the decrease in earned capital for the expense. So, accounts receivable, I'll abbreviate AR, is an asset. We're going to increase that with a debit of $25,000. We are also going to debit our cost of goods sold. Expenses are increased with the debit. So we're going to debit cost of goods sold, $8,000. And then our two credit accounts, we've got a credit account of revenue, to record the increase in earned capital for the revenue, and we also are going to have a credit to inventory to reduce our inventory asset by $8,000. You can see that the total debits in this journal entry total $33,000, the total credits total $33,000. Our journal entry is in balance, and our fundamental accounting equation will remain in balance. Our sixth transaction is to pay employees $7,000 for work that they have performed. So we're going to pay employees, so it's going to mean cash is going to go down by $7,000. We need to offset this either by decreasing liability. Well, we're not paying off a liability we already owe. We weren't told that these people have already worked for us and we've owed this. We're paying them sort of as they work. So it's not a liability that we're reducing. It must be an equity account. It's not contributed capital. The employees are not owners. We're not paying them back anything they've made. It's not revenue. It must be an expense. And that's in fact what it is. The $7,000 wage expense is going to decrease our earned capital. It's going to reduce the profit that the business has made. And so we're going to record that as a reduction in earned capital. An expense account gets a debit. So wages expense, we're going to debit that $7,000, and to record the reduction in cash, we're going to credit cash $7,000, and that is our sixth and final journal entry. So for these transactions, the issuing of common stock, the borrowing money from a bank, purchasing a building, purchasing inventory, selling half of that inventory on account, and paying employees, we have analyzed the effects of these transactions on the fundamental accounting equation, assets equal liability plus equity, and we have also created journal entries to record these into various accounts. Now, as we have recorded these journal entries, we have these independent journal entries that are all sort of listed in the general journal, which is essentially a listing of the transactions. That's good, that's helpful, that's useful, but it's not a very good way to summarize the transactions that have happened. If you want to know what's happened with cash, you'd have to search through the entire general journal and figure out all the accounts, or all the entries that have happened to the cash account. In order to prevent having to search through all these things, we summarize what's been recorded in the general journal in something called the general ledger. The general ledger is just a summary of all the events that have happened in the general journal, and we use T accounts to collect all the transactions and present them in a nice summary format. So let's take a look at the transactions we recorded, put them into our T accounts, and we'll see how this is a much easier way to understand the events that have happened. Let's take a look at our journal entries. Our first journal entry we recorded was for the issuance of common stock. We debited cash for $50,000, and we credited common stock for $50,000. Journal entry 1, we simply put the debit in the cash column, or the cash T account, and the credit in the credit column of the common stock T account. Our second journal entry was recording the borrowing of cash of $40,000 from the bank, crediting cash, debiting note payable of $40,000, recording journal entry number 2. Our third journal entry was recording a debit to the building account to record the cost of the building we have purchased, and recording our first credit to cash to record the reduction in cash. Our fourth journal entry, recording an increase in inventory of $16,000 and the corresponding decrease in cash of $16,000 because we paid the cash for the inventory. The fifth journal entry was our two-part journal entry, recording the increase in accounts receivable of $25,000 and the increase in cost of goods sold, or our decrease in earned capital of $8,000. So it's $33,000 of debits or $33,000 of credits come from a $25,000 credit to revenue and an $8,000 credit to inventory, recording the reduction of inventory for the half that we've sold. And our final transaction, number 6, recorded the paying of cash, $7,000, and recording the increase in wages expense for $7,000. I hope you can see that this is a much simpler way of getting a summary of everything that has happened to each account than just leaving everything in a general journal. Now what we will now do is simply sum and total all of these. If we look at cash, we have a total of $90,000 of debits, and we have a total of $53,000 of credits, leaving us with a net balance. Our debits exceed our credits by $37,000. So that's our net balance in the cash account. Accounts receivable clearly has a debit balance of $25,000. Inventory has a total of $16,000 of debits, offset by $8,000 of credits, for an $8,000 debit balance. The building account, $30,000 debit balance. Note payable, $40,000 credit balance. Common stock, $50,000 credit balance. Revenue has a $25,000 credit balance. Cost of goods sold has an $8,000 debit balance, and wages expense has a $7,000 debit balance. Now, of course, you can see with most of these accounts it was extremely simple. There's only one transaction in most of them, but for inventory and for cash, we had accounts that had 2 or more transactions, and so the net is just the larger debit or credit balance minus the smaller. In this case, cash had $90,000 of debits, $53,000 of credits, so the net is a $37,000 debit balance. So we have summarized all of our transactions in a general ledger. So now we can look at the various accounts and see the balances in each account. This is very helpful. It's not the last thing we need, however. It's nice to know that our debits in total equal our credits. So what we can do is something called a trial balance. We can take our general ledger and summarize all of the balances of the general ledger into the trial balance. Trial balance is simply a list of our accounts with a debit or a credit balance in each one. Now you'll notice that as we move from the general ledger to the trial balance, we lose all the detail of the transactions. In other words, if all we are reporting is the balances, and we don't report all the individual transactions, then we lose the detail of the transactions that happened. That is true. Part of what accounting does in reporting things is to summarize, and we do lose some of the detail. The assumption is that all the decision makers who use the information don't need all the detail, and they're better off having summary information than having all the detail. And in most cases, this is likely true. What we'll do is simply transfer the ending balances of each of these accounts into our trial balance. Cash ended up with a net balance of $37,000 debit. AR had a $25,000 debit balance. Inventory had an $8,000 debit balance, and our building account had a $30,000 debit balance. Note payable had a $40,000 credit balance. The common stock account had a $50,000 credit balance. Revenue had a $25,000 credit balance. Cost of goods sold was an $8,000 debit, and wages expense was a $7,000 debit. If we summarize, or we total these accounts, we can see that both our debits and our credits total $115,000. So our debits equal our credits. Certainly not the number of debit and credits accounts. We only have 3 credit accounts, so we have 6 debit accounts. But it's not the number of accounts that matters, it's of course the dollar value. So we can see that our debits equal our credits. This is reassuring. We know this must be true for our accounting equation to work out. It works out, so we are somewhat assured that we've recorded our transactions reasonably well. Now, what do we do with this trial balance? We can use this trial balance to create essentially our set of financial statements.